We are live. This is Senate Finance. This is February 25th. And committee, I'm sure you are all going to be terribly saddened to know that our last agenda item has been canceled due to illness.
Oh.
Sad.
What?
And I've been trying to run around and fill it, but at this late notice, all the staff is busy.
Uh-oh.
We just found out.
Somebody's
I'm sorry that there is illness. But it seems to be endemic in this building.
Yes.
So we're going to start out today. And Patrick is here from Joint Fiscal. And just trying to, we keep hearing about the huge federal tax cuts that wealthy people got. And I thought we'd see if we couldn't get a little granularity to that. Because it usually isn't that across the board magnificent, but maybe it is. So Patrick's gonna break down and there. New computer doesn't have a button.
Can I ask for
Yeah.
clarification, Madam Chair? So is the 215, all of that is postponed? Everything for that's at 215? Is that what you meant?
No, 315, 161, the scholarship and granting organization.
Oh, that got taken off.
That got taken.
I see.
We are still gonna do credit card fees.
Okay.
Okay.
All right. Well, I'm Patrick Pearson with the Joint Fiscal Office, and as the chair mentioned, and the request for today was to think about how and look a little bit more into how the federal personal income tax changes were going to flow through into Vermonters' federal tax returns. And we can talk a little bit what I mean about that with you, but there is some there are these great charts on the tax department's website, and they have them organized in a couple different ways. One of which is breaking things out into quantiles. So what you're looking at here is percentile distributions of different income categories. If you look at this returns tab, you can see that for each block of people that is about 10% wide, that references about 33,000 taxpayers. And you can see that, you know, for example, top 1% in Vermont as of the date of this data was about $586,000 in EGI. So I guess just looking a little further, if we kind of focus on that line there towards the bottom of the top 1%, that refers to about 3,300 tax returns in Vermont. They account for roughly 5.1 billion in adjusted gross income, which represents about 17% of total adjusted gross income in the state. Further, that sort of ends up translating to about $345 million in personal income taxes, which accounts for about 30% of Vermont's collections from that group. And if you widen that to be the top 5%, so that's the 95 to 99, the top one columns, their income is contributing about 52% of total personal income tax collections to the state on state returns. So I'll just pause here for a moment. This is sort of what the general income distribution across the state looks like, broken into percentiles. So when you think about, I think the top 1% is an often reference group. What that means in Vermont is that you need an adjusted gross income of about 586,000.
The bottom 30%, I see the minuses, so I assume they get tax credits back.
That would mostly be due to refundable credits.
Okay.
Yeah.
And in a state with a flat tax like Massachusetts, all of those taxpayers would be paying whatever their tax rate is.
4%, I think,
4%.
that's the whole, and then an additional.
Right, but yeah, so that bottom 30% would pay more under a flat tax system.
In the absence of credit, offsetting credits, right? Yeah.
Okay. Okay. Questions?
Girl, first I'll say thank you for pausing. I appreciate that.
I'm gonna pause on every slide.
I love the
Yeah.
pause. So this is state tax, not federal tax, and this is 2024. Or is there's no 2025 yet?
Well, people are filing their 2025
Right.
taxes right now.
Right.
So,
Right. I answered that myself. Are you predicting any major changes?
well, I mean, if you look at, how this has changed over time, actually, this is a good segue to the next slide. Because the one thing that I looked at, and this is 2022. Because that's the latest the IRS had published on their website. So we're comparing same year. And one thing that kind of jumps out at me is around the median, that 50th percentile, Vermont pretty close to what it looks like nationally, about $50,000, both in Vermont and nationally for AGI is kind of around the median point. Where there is more significant difference between what it means to be in this income group, that's at the 1%. So in 2022, if you were a Vermonter in Vermont, you would have been in the top 1 percentile if you had about $520,000 in AGI. If you could look at that nationally, that number is more like 663. This is since 2022, all those thresholds have gone up, right? So, but I think one thing it does show you or suggest maybe is that Vermont's differentiation as you go up the percentile is not quite as steep of a climb as it is nationally. Just maybe potentially indicating, I'm not saying this affirmatively, but potentially indicating that there could be a little bit less of a gap between that top 1% and what you might think of at the median level.
Wait, I don't.
I can elaborate.
Okay.
So, are you saying that Vermont's income we're a little more progressive than the federal rate schedule or we're less progressive?
We are, so I'm purely talking about what income it requires to fall into
Yeah,
the certain bucket. So this is sort of thinking about it thinking about anything to do with taxes.
okay,
Yeah, this is just what income you need to be considered.
qualify.
Yeah, this is
Okay.
pre-tax AGI.
To be in those tiers, the
Yes.
percentile.
Yeah.
So, and this isn't layering on the tax rate for those tiers yet.
Yeah, so it's a little different than what we saw here. It's essentially just comparing this one column here
Yeah,
with that same column, what it looks like on the national average.
okay.
Yeah.
Yeah,
Our top 1% is not our top tax bracket.
No.
Yeah.
And I guess another way of putting it is Vermont's top 1% is lower than the national top 1% in terms of what income you need to be defined as being in that group.
So our K economy is not quite as K as some K economies. Our K is smaller.
it's a lower case.
It's a lowercase K rather than capital K.
I'm not sure I know what that can is.
So
Is it
It's the
shape of
listing
the
on,
chart?
It's
the latest.
It's the trend in the building pattern
Oh.
that we're
that if
talking
you
about.
are at a certain income, your buying power essentially is going up. You're not doing well in the economy. But if you are in another income bracket, your buying power
Okay.
is going up.
I'll have to remember
Another,
that term.
it's sort of like alligator thing.
Oh.
Yeah, I was gonna say, this sounds like the alligator.
It's not, everybody's not going up and everybody's not going down. Some people are doing better and some people are doing worse.
Yeah.
But I don't know if that's gone beyond the web.
So do you layer on the tax rates to that?
Well, in a couple of slides, we'll have sort of a crosswalk because what I want to highlight here is what we have available to do some of this analysis is the federal estimates of federal changes in tax liability. So what I'm trying to attempt to do here is tell you, in a sec, we're gonna try to convert Vermont returns into the buckets that define the federal quantiles.
Okay.
And so, and I think it's in a couple slides, you'll sort of see, based on the JCT analysis of HR one, what Joint Committee on Taxation, I think, what their federal estimates look like if we crosswalk Vermont returns into their quantiles.
Okay. Okay.
Yeah.
Awesome.
I'm clear when we finish, actually.
So next, I just wanted to highlight several of the provisions that are quite large in the bill and draw a little bit of a distinction in terms of the types of provisions. So the first set are those provisions from TCJA that were set to expire, but HR one made permanent.
Okay.
So if you were to compare what's tax year 26 to tax year 25, they're going to look pretty, these provisions are going to look pretty similar because it's not actually changing people's experience from the prior year, but it's still being booked in as a cost or effect on revenue. So that's where they extend the extension of the reduced income tax rates, the extension and increasing of the standard deduction, termination of permanent personal exemptions, I should say, and a few other things.
I wonder what that was.
That should say personal exemptions.
Okay.
So those are actually all areas, if you remember back when TCJA was passed, that will not decoupled from and sort of set in statute in Vermont for our tax code, our own standard deduction and exemptions as a way of muting sort of the bilateral effects that some of these law changes were.
So with those, because they're an extension, folks with the reduced income tax are not going to experience an increase in revenue because it's not changing. And the people at the bottom are not going to experience an increase in revenue because those tax cuts or the tax credits are not changing.
Yeah, the cost estimates I've seen associated with these, they're accounting for what would have happened if these had been allowed to expire. So on a year-to-year basis, it's going to look the same going from permanent or from temporary to permanent. But from an accounting perspective, that does reflect a loss of revenue because the prior law was set to expire.
Yeah.
And it's an important thing just to keep in mind when looking at all these numbers is that from a year-to-year experience basis for the taxpayer, it might not look all that much different from the year prior, specifically to the TCJA provisions that were temporary and are being made permanent. There are some other areas where there are expansions.
Yeah, that's what I was gonna say.
Yeah.
There are other things
There are
that went
other
on
things.
top of the TCGA.
Yeah, so in that second, major bullet, those are all provisions in HR one that are new and represent change from prior year tax treatment. So that's where you have your qualified tips, the overtime deduction, car loan interest, the senior enhanced standard deduction, and some other expansions of credits that were not tied or related to anything in TCJA that was temporary or what have you.
And those are eligible for across taxpayer categories.
Yes.
Yeah.
And I guess one other thing I will say, going back to the provisions from TCJA, so I have the child tax credit listed there. So they did make that permanent, but they also enhanced it in a way that it's more generous and some refundability conditions. So while it was something set to sort of sunset, it is something that was also expanded. So there's some nuance all over the place.
Because we have a tax. No, our child tax credit is not
We have our own structure. for it,
Yeah,
so.
not tied to that one. Some of them they are tied to, but
Mhm.
not that one. Okay.
Yeah, some examples would be the Child Independent Care Credit, which you
That's
see
what I
here
was
as an expansion. Earned income tax credit is another one where we just use a flat percentage of what you're eligible for on your Vermont return or your federal return. Yep.
Okay.
What about what we were supposed to be looking at today, but now we're not looking at, which is that it is a tax credit. Is it up there?
That's 161
Oh, the
of the governors.
I think we have the tuition
Oh, that,
at that.
sorry. I meant that as in, oh yeah, I know what you're talking about.
Um,
That wouldn't be as major of a provision, compared to anything else you see on the screen in terms of, overall impacts to federal returns, right? Because that's a federal tax credit that's not going to show up on your Vermont return. So ultimately, that will be end up being something we don't have a lot of visibility
Yeah.
in terms of Vermonters receiving it. Okay. I have one more slide before I show you the crosswalk. I just wanted to, like, we talked about this, we're taking Vermont returns, putting them into the federal, quantiles. I just want to reiterate that the underlying estimates that were done by JCT. I shaped them a little bit to make them, sort of, I keep using the word crosswalk, but make them more Vermont specific. And then, yeah, just again, HR 1 does make permanent some formerly temporary provisions, and just keep that in mind when thinking about the scale of the numbers, because when we do go to the crosswalk and you come right down here, it's almost $1 billion that is, through this methodology being suggested, Vermonters are saving on their federal income tax returns.
wow.
In 1 year.
Um,
Yeah, bro.
I believe so.
What happened to the 90th to the 95th percentile? They're kind of a hole.
Well, it is going from, so we have quintiles that transition into a decile, and then that's it's a step of 20, step of 20, step of 20, step of 10, and then so that's why the returns for those smaller percentiles shrinks up. And actually, so if you remember, ITEP was in here, Carl Davis, you took testimony on. This is this column on the JCT estimated average returns. That particular column is the same thing that he was doing. Analysis.
1%. Right, so the top three are actually make up 5%. Yeah, so.
Mhm.
Got it.
And yeah, you can see here that as you go up the income spectrum, the average size of those tax reductions does increase.
My quick math, 70% of the tax benefit went to the top 20% of the people.
Is that right? Quick math? Yeah.
Yeah, look at the top 20%, pay 80% of all the income taxes too. So it kind of lined up.
Yeah, if we think back to the very first slide we looked at, it was the top 5%. I think we said we're contributing about 52% of Vermont income tax receipts.
But is this?
Sorry, still processing.
Happy to pause. This is the last content slide, so if there's anything you wanted to revisit from previous ones.
Which of those Of those 324, the highest 0.1, I think above 2 million, those are gotta be just mostly asset sales, right?
Yeah, I mean, oftentimes we do see that, and it's not all the time, there are some persistently higher income individuals. But there are one-time events for a lot of people
Yeah.
that will, like sale of a business, sale of a home that you have owned for a long time. That can cause temporary, sort of spikes in lifetime, sort of income.
Doesn't take much. I can think of at least one home that would never catch your attention in Montpelier that sold for over $1 million last year.
Although too many people that actually have $2 million of W-2 income. On a regular basis, that's a lot of income.
Who knows? And we are going to go after some of the stocks and some of the unearned income. And one with what?
So to Beck's point, if you go back to your slide 3, so it is worth crystallizing that right now, by my math, 78% of the income tax is coming from the top 20% of the people too. So
Yeah.
we're giving a discount to where the monies are coming in. Yeah, good point.
But those are also the people that make all the money. So.
No, I know. The people that make most of the money pay most of the income tax.
And it would be interesting to see if any of the arts keep. I'll bet you the hospitals. But I remember the discussion around charitable deductions. Those are also the people that endow scholarships and university chairs and wings on the hospital that don't show up there. We had the McClure Foundation, people that remained on Friday. And I'm sure they were in that bracket. But the Tarrant Foundation did a lot of good in the state. So there's other places that money goes that it might not go if we take it, but we don't know that. Okay.
Can I ask a question?
Yeah.
Do you have this as a percentage of their income, because, I mean, you can look at it as the people who make the most pay the most, but when you look at it from the percentage of their income, are they paying?
Like a effective tax rate.
Yeah.
Yeah, so I truncated the chart that the tax department has just to get it to fit, but I can absolutely send you that. And so the far right column will show you the effective tax rate, essentially. If you divide their taxes by their income, what does that actually show you?
Yeah, and then if you combine the state and federal tax payments, what is the percentage too? Because both, just what is it when you do federal, what is it when you do state, and what is it when you do combined? Because
The overall tax payment to government.
yeah, and I mean, I actually also, I mean, I think I've made this point in here too. This is just looking at income tax, which for Vermont, our income tax rate structure is very progressive. But then when you add on, sales tax and property taxes and other taxes, which are especially sales tax, more regressive, and more paid by lower income people, then what is the effective tax rate? And I think that's a more complicated analysis, but there must be something that's done that kind of thing.
I tap that all back.
Exactly, yeah.
It's the who pays report.
The who pays, is that ITAP who
Yeah.
does that? Yeah.
They publish that.
See it by state, it's really good.
Yeah,
Uh,
that's where I think that
I
we're
think the
not.
one caveat with that report is I do think that fees are not included, and I do think that it excludes 65 and over.
Okay. Is that on our website still? Was that,
Let's see, I can send it.
can you send it to me? Okay.
Yeah, we'll send it to all of us.
Yeah, I think
I'll
that's
send it to Charlotte. So,
just,
But to your point.
Yeah.
Trump tariffs were taxes and they were quite progressive and those are falling much more lower
Exactly.
proportionally to their income. So I feel like if you're looking at the income tax and overlaying it also with who's been paying those Trump tariff taxes,
Yeah.
that would also be a relative important thing.
You know, I think it's been fairly well documented that Vermont is a small state and our tax burden is high. Our quality of life is also high. We get recommended as a great place to retire, I guess, if you have money. Because other ones will say, other than if we're expensive, we're a great place to retire. We can look at all of this, but we can get so far into the weeds that we'll never get out in a week.
I guess the point I'm trying to make is that the wealthy people who are the people who have the money may be paying more on a dollar amount.
Right.
But when you look at it as a percentage of their income, they're paying probably far less. And that when you look at the full tax picture, and they are benefiting from the services that we provide as public services, and can afford to pay more than people with lower incomes.
What one can afford to pay is sometimes a personal judgment, like what is fair. We are going after a set of wealthy people who do not pay taxes in Vermont, and that is the second homeowner. So that should be put in this equation also.
Well,
They are enjoying the services and the environment and the sometimes paved roads. that the
right, and
rest
they're
of
not
the-
all, there are plenty of Vermonters that have second.
They
homes in
are
Vermont,
not
too.
all well,
Yeah.
but they will pay based on the value of their homes. Okay. So it will take a while to go through this and then adjust this. Because we're into percentiles and I'm used to thinking in terms of brackets. And I'd like to raise or put, I guess, a top bracket in or raise the bracket. And help those, I guess, to the 90 to the 95th percentile folks. But the salaries that pick up, this is filing jointly, so two not high-end professionals, but two professional, but not.
These quantiles, I will say this is everybody. It's not broken out by filing status.
Okay.
Yeah.
Okay, because our brackets are, which is what I'm adjusting.
I know you've said this before, but it takes a while for it to sink in for me. Can you explain to me how our current income brackets are defined? Do we set those as a track with the federal government? Where are our thresholds and how often have this been calibrated over time?
Oh, I never remember the exact dollars off the top of my head, but
It varies with inflation, that's,
There's the question. Okay.
yes.
yeah, so Vermont has its own standalone tax brackets. We're not pegged to the federal structure in any way with that. So we have our own, and each year, yes, the levels of the brackets do increase. I think it's in statute, tax department has to use CBIU to increase each of those brackets. So you can kind of see naturally as incomes are raised right at that time, it's increasing the brackets over time to sort of keep people in the same context of the bracket they are from, a starting point to an end point as incomes are generally increasing over time.
So I'm very interested to know when we set up that formula, the base amount to the CPI, because we are in a new tax landscape with the big beautiful bill with HR1. So understanding what those were set at when, how long ago, and looking at what would track with what our intent as a state has been, what they should be today is something I'm interested in.
We
Does that make sense?
did, and it was Michael Costa from Gifford Hospital, And Randy was here. We set up a Blue Ribbon Tax Commission. We had 5 tax brackets and it was what, 200? The early part of the 2000s?
Yeah, it was 2008 or 9,
And
something.
that's what I thought. And the concern was all the national people took that top tax bracket rate and rated us unfriendly to business because we had that high bracket. And the commission's job was to bring us into a more competitive tax thing.
I think part of the rationale was that as a result, and regardless of how you put it down, you wind up penalizing the most wealthy person who is typically also the person who pays the most taxes. And there comes a point at which they are more mobile than those who are at lower or medium tax brackets and don't have to stay here more than 6 months and 1 day.
And they also came in with recommendations on deductions, which the tax cut and jobs bill kind of fixed. Because other states like Massachusetts, you could take 1 deduction, you could take no deductions, you could take a certain percent deduction. There were many different but itemized deductions, at least in the surrounding New England states. And I'm remembering, and this was 20 years ago, were not as complicated as ours and weren't as liberal as ours. We collapsed those top 2 brackets. And I think we set the rates then. A lot of work was being done at that point, when we set the brackets, trying to find a way to lower the brackets in the middle class. It's like if you tax the rich with property taxes, there was this bubble effect, and couldn't find a way to do that without hitting the middle income. It kind of stayed that way until the Tax Cut and Jobs Act. And with that one, the state benefited $30 million. So we rewrote deductions. We had already the year before decoupled down to adjusted gross income, I think. But we did a whole lot of reworking then, which would have been 17, I think, 2017. But we didn't really play with the tax bracket. So they've been with the 4. I think my concern is that as inflation and other things have gone on, that we are having an awful time recruiting doctors, especially primary care doctors, people who would fall into that lower level of the top tax bracket. And New Hampshire is next door. And so I'd like to see if we bump, maybe put the 5th bracket back in and do that. And look at Massachusetts as 0.25% above us, see what that might do in the way of income without it being a huge shock. It'd be a fair amount of money.
Raise the income tax rate.
The top rate, we're always being compared to Massachusetts. Massachusetts is 0.25% above us, but you remember the tax department last week said if you make $10 million, you actually pay more here because you're paying on the tax on everything over 300,000.
You're effective.
Your effective tax rate is the actual cash you pay in is more than you pay in Massachusetts, because they're only paying it on the billion up.
Right.
So
I'd certainly be happy to come back and, like,
Okay, that would be good. And that's it?
yeah,
Okay. Perfect timing, because the world's changing. What you mislead seats for you. And we don't have an enforcer in here to make it believe we're over our age.
I can do it if you want me to.
No, I don't want you to. I miss having people sit in the windowsill behind.
Oh, wow. That was. It really is.
That's a great.
Yeah, it's great. I'm gonna go get some water.
Okay,
It doesn't confuse.
we're gonna.
Yeah, it's more comprehensive than I.
The thing will be, yeah, what we can do is put it together. Great. There,
What'd you do that for?
I just, it's feeling quite big. Okay. Oh. So we're gonna be looking at 135, which is actually a holdover from last year. And Rick is here. Now, this is the prohibits credit card fees and the amount of transactions that is taxed with gratuity and required retailers to accept cash for all transactions under $500. We took testimony on this last year. We learned that the swiping fee issue was in court, decided no sense doing anything until the court case has settled. I've heard by way of rumor in the hall that the court case was settled. But I think they're making further action since then, so we're gonna just find out where we are and what people think. Rick, the floor is yours.
For example, with the office of counsel, is any court case really ever settled, Madam Chair? Is any court case ever really settled? That's the,
Probably not in this country. We're very litigious with money.
you appeal the appeal. So I guess my first question is, do you want a walkthrough of the bill first? Do you want like an overview of the
Let's
bill?
do a real 2,000 foot
Sure.
walkthrough, because it's been a year or more since we've walked.
Yeah, I'm happy to share my screen. I'm joining the Zoom. So it is S-135. And there are two parts of the bill. The main part that I think that the court case did speak to is the section 1, the major part of S-135. Section 2, as the chair mentioned, is a small section about cashless prohibitions, which we'll just take a second to get to, but we'll start with the bill in order. And it does start with the credit card fees on tax and duty. So again, kind of an overview, what this bill is when a consumer goes to a store and pays for their goods and services with a credit card. I can't begin to explain how complicated that transaction is for us. You just swipe it and you're done, or now you tap it and you're done. It takes a matter of seconds, but a lot happens during that transaction. A lot of networks are contacted, make sure you have them and so forth. So what this bill would do is regulate a part of that transaction to where when you pay with credit card, let's say it's 3% that the issuer charges, or the network charges you, charge the merchant for the transaction.
Charges the merchant, not.
Correct. Well, yes, and then sometimes the merchant charges the consumer.
Yeah, sometimes it's figured in the
Yes.
cost of whatever I'm buying.
Certainly. So for argument's sake, that 3% applies to the whole transaction. Let's say you $100, it would be a $3 fee, right, to that $100 transaction. What this bill would do is slice out any taxes, sales taxes, for example, or gratuities on that bill. So if the bill was $100, and that included, let's say, $5 in taxes, that's really low. Whatever the amount would be in tax and gratuities, let's say the total is $100 again. That amount would be different because the 3% would not apply to that sliver of the amount that is taxed and gratuities, whatever that happens to be. $5, $10, whatever that amount is, would not be part of.
Sales tax would be $6 on 100, so.
Yes, I'm not good at math.
Yeah.
Yeah, what's the math on that fee then? 3%.
3%.
Are you,
3%, 6%.
JFO just left. Oh, boy, that would be great to answer the question.
You might not be the right person to ask, but I want to just put this on the table as what I think is one of the big hindrances for this moving forward is there's a big difference. When you said the transaction, lots of things happen.
Yeah.
I think it's important just to make sure we're all clear that the itemized receipt, what do you buy at, say, Costco, all the 10 or 15 or 20 things you buy, or if it's at a place with a tip. Those items, as individual line items, are not sent to the credit card companies. The credit card company does not know that you bought this much in produce, you bought this that had a sales tax, and that had a meals and prep tax. They just know the total amount. Like credit card companies, when I look at my credit card statement, I see the total charge, not the itemized, the granular items. And so in my understanding, for this to work, we would be mandating that credit card companies start to collect item level transactions, or forcing all of the systems out there, the point of sale system, to clearly separate out taxes, tips, and other items. And then the credit card companies would have to disassociate those amounts. So I'm just curious, since no other state's done this, Illinois is trying, they're in courts right now. Does Vermont have the right? Do we have the ability to dictate interstate commerce, or would this only apply to Vermont banks? Can we really tell international credit companies that they got to change their systems to start tracking these differing item level amounts on our cards?
That is a loaded question, Senator.
Yeah.
And I can answer part of it, but not most of it. So the technical aspects, I can't speak to. The data limitation you're kind of referencing appears to be a question, but I also kind of answer as far as what credit cards would need to know about a certain receipt. In this bill, the merchant would have to inform during that transaction what part of that transaction is gratuity or taxes. Presumably, the point of sale system would handle that in some kind of way. Again, not my expertise, but you're right that there are some concerns, and the court brought up those concerns in some aspects. It did not talk about interstate commerce, this decision, because actually it wasn't argued as violating interstate commerce. So I think that would be something that another court may look at some point.
Okay, but the credit card company is charging me for the privilege, the convenience of not having to pay cash. I just have to carry my credit card, and I don't have to carry cash upstairs to the lunchroom every day. But when I check out my lunch, the rooms and meals tax is included. If I just said, I'm going to pay you the whatever dollar for the meals tax, and I'm going to charge $5 of my $6 bill, then I'd only do it. I'm being charged for the service, not for what it is. You use your credit card, you use the service of the card, not
But you don't pay.
It's the food service.
the food.
Food service.
Yeah, the food service.
Yeah.
Well, yeah, the food service pays, but they're gonna. Yeah, they pay,
They pay.
but the theory is I go there because they will accept my credit card. They don't have to accept credit cards. They are probably, if I had to deal out the cash every day, I might not pick up that wonderful looking pastry that's sitting up there, or the bag of potato chips, because I've only got $5 and I can't buy that today. Or I might decide I'd get a glass of water out of the fountain. So there's balance here. No one has to use credit cards. Only if they want sales.
Well, I think, a couple of things. There are actually more and more places that don't accept cash anymore. So I mean, that started during the pandemic. It's just sort of, especially now with the penny issue. And if I'm recalling from the testimony we heard last year, the interchange fee, which is the fee that we're saying, the bill is saying wouldn't be charged, is a fee that's for the sort of electronic payment transaction. It's not a fee to the credit card company. It's for the
Somebody else.
yeah, it's for the sort of the middle. I hate that term,
Middle
but
AI?
the middle AI,
Middle person.
the middle person. And is that us? Because we're in the middle here. But and I think the point is that okay, you're buying a service or an item, a good or a service, goods and services,
Yeah.
but the part that the bill would not want to charge that fee for is the tax, which the vendor is not charging, literally, we're charging the tax, and the gratuity, which is what you sort of pay to thank somebody for their service. So it's taking out the portion that is paid that is not
Right.
for the goods or the services, and saying that shouldn't be charged this interchange.
And I guess that's what's being argued is it is part of what's, if I want to pay cash for that, then it wouldn't go through and it wouldn't get charged.
Right, but I don't think, I mean, you could pay cash for tips in a restaurant,
Yeah.
for example, but you couldn't just say, I'm gonna pay, for my $20 dinner, or lunch, breakfast, whatever you can get with $20 nowadays, but I'm not gonna pay the tax with it. Like, that would be hard to
Yeah.
say, I'm just gonna pay the tax and the tip with cash. So, and I think that, that part of this is to help small businesses not have to pay this interchange fee as much, especially small restaurants.
Yeah.
Which we have a lot of in
Right.
Vermont.
And I think we've tried several times. And have run into issues to do something about credit card fees. Done a few things like allow people to set a minimum purchase. Because if you buy a pack of gum, the fee is more than.
Then the
Yeah.
yeah.
So let's let Rick finish. I'll be quiet. And the idea was, what is happening now?
As far as the court cases or as far as the rest of
Just
the bill?
just walk us through really quickly.
Yeah.
We'll all be quiet and
Yeah. If there's a question, obviously, but I'll skip the definitions, although I think you should review those, and you'll hear from witnesses as far as if they're affected and how they're affected by this bill or the pass. But on page 2, 3 of the bill, there are actual requirements of the bill. So with a transaction involving a merchant, no issuer, payment card network, acquirer, bank, or processor shall charge or collect from a merchant an interchange fee on the amount of the transaction that is a tax or gratuity. A merchant shall transmit the amount that is tax and gratuity to the acquirer, bank, payment card network issuer, or any designee of the foregoing as part of this transaction. If one of those entities does not receive from the merchant that amount, then you can charge them the full amount for the entire transaction. That's subdivision B. A merchant that does not transmit that amount that is tax and gratuity as part of the transaction may submit tax documentation showing the tax and gratuity amount not later than 180 days. So you have roughly 6 months, the merchant after the transaction where you are charged the full amount for the full transaction. You have 180 days to submit documentation to the entity that collects to get money back, which is addressed here in a second. An acquirer, bank, payment card network issuer, or any designee that receives this tax documentation not later than 30 days after receiving it shall credit the merchant for the amount that was previously collected. A merchant that submits an amount that is inaccurate should submit with the corrected amount 30 days after the notice that it is inaccurate. If the corrected amount is greater than what was reported by the merchant, the acquirer, bank, payment card network issuer, or designee shall credit the merchant the difference between the two. If it is less than what was reported by the merchant shall credit the bank, network, issuer, or designee between the difference of the two amounts. Make sense so far? Most of this last part was about the merchant submitting information later or submitting an incorrect amount to the.
I think there was a discussion as the terminals don't always,
This is a new thing.
Yeah.
This is Illinois we talk about does not have their situation set up here. So this is going to be a situation if you would pursue this. 4, it shall be unlawful for an issuer, payment card network, acquire, bank, or processor to alter or manipulate an interchange fee of a transaction in an effort to circumvent the effects of the section. The penalty section, any issuer, card network, acquire, bank, or processor found to have violated the section shall be liable for a civil penalty of $1,000 per transaction. Any merchant whose rights have been violated may maintain a civil action for damages or equitable relief as provided in the section, including attorney's fees. This violation would bring in the Vermont Consumer Protection Act, which allows the Attorney General to conduct civil investigations, bring civil actions, et cetera, under the Vermont Consumer Protection Act. So that's the interchange section. This last section on page 6 is totally different. It is requiring that a seller or lessor who offers goods or services to consumers shall not refuse to accept cash as a method of payment unless the transaction exceeds $500. And a person who violates this requirement would also violate the Vermont Consumer Protection Act.
Maybe not for Rick, but just another touch point that whoever's going to speak next, I would like to raise. What I recall of this conversation last year is that this would only apply to Vermont-based banks that would be forced to do this, and that it wouldn't apply to any banks out of state. If that's not correct, but I just would love to know what the scope of our influence over these interchange fees are, because I think that is an important, relevant discussion, especially since no other state has successfully done this.
banks can be chartered either with the state or with the federal government.
I'm not talking Visa or MasterCard, but the third party. So Visa and MasterCard facilitates it, but if the backing bank is like your local bank, those are the people, if they're based in Vermont, that would have to conform to this new reporting structure. My understanding, but I'd love to validate that.
The court case, I think let's maybe transition to the court case, because that is addressed in the court case. That was released 2 weeks ago, very recent, February 10th. So let me first preface, this is a district court in Illinois. This is not in our circuit court. We're in the second court of appeals. So even if this decision were to be appealed, which I'm sure it's going to be appealed, and if the appeal were to be different than this decision, it would not directly affect Vermont. Certainly it's persuasive to a court of Vermont that may say, okay, this is what, and even this decision is somewhat persuasive to Vermont, but again, it's one judge, something to keep in mind. However, the law in Illinois is not identical, but it is very similar to S-135. There's a few things that are different. And in fact, the main thing the court tossed out of the Illinois law is not in the Vermont law, and that's the data minimization part, which I'll get to. So really, the court's decision almost fully supports what is in S-135. Just first, but again, there's some things to think about here. So it just came out 2 weeks ago. The court initially issued an injunction, preliminary injunction. That's why the committee, I think, stopped working on it last year. So it's somewhat of a surprise when the court changed its mind. It initially issues a preliminary injunction for the bankers in Illinois, and then for actually we have, upon further consideration, we decided to grant the not, basically undo the injunction and award the case to the defendants, in this case, the Attorney General of Illinois. So what I really, this is a 18-page decision. I'll just read it word for word. I'm just kidding.
Please.
Although I am, this is what I do, right? I love when, of course, the early humans first venture into barter and economic exchange. Like, what am I, caveman? What am I doing? I'm not really about it. But it's actually, the judge does say this was a close call, which I think is interesting. The judge made the decision, but I think she also said that this was a close call, whatever that's worth.
I was gonna ask you,
Yeah.
what's a close call in the
You're showing a 50-50.
I don't see
I don't
that a
know
lot
that
in
often.
opinions. I'll show you exactly. Actually, it says close case, excuse me. Let me pull up let's see, the merits right here. This is a close case. See, not my words.
Not, this is a closed case.
Close. Yeah, it's a close case. It is not a closed case. I'm guessing the bankers will appeal. So again, getting to the part of the opinion that really matters is the argument that the Illinois Bankers Association made is that the bill is preempted by federal law. That was their main argument, that you can't do this because national federal law already regulates in this area. And when the state tries to do something that is already being done or could be done by the federal government or Congress, that the law is preempted and you cannot enforce it. So the main federal law the bankers were referring to was the National Banking Act, which I am not an expert in. I think my colleague Maria Royal would be able to provide testimony if you'd like. But that law applies to national banks, obviously. And the way that the opinion is separated is into various entities. So as far as the nationally chartered banks is the first set of banks the court looked at, and the judge said, the National Banking Act does regulate national banks and the state can't interfere with what the National Banking Act does. However, the crux of this is that the fees that are charged to merchants are not charged by the banks. They're usually charged by the payment card networks. So while the bank's a part of the transaction, the court said yes. However, as a bank, you are not being directly affected by this. You are indirectly affected because you're part of the entire transaction. You don't set the fees. The payment card network set the fees, the 3%, whatever that happens to be. So I could be more detailed, but that's kind of the crux of it, is that the banks don't really have the preemption argument is not maybe the best argument. There could be the interstate commerce, but they didn't really.
Just real quick. I can't remember from last year's testimony, but can the bank take a slice of that fee? Or are they not involved at all?
Can the bank take a slice of the? I mean, everybody in that transaction except for the merchant has some kind of cut. Right? I don't know how it's divvied up, but
So if I'm a member at Scott Beck Bank in Vermont, based bank,
Yeah.
I swipe my card that I have through Scott Beck Bank.
We'll take a cut.
Okay, and then the card company takes a cut.
no, I'm not the best person to ask. But I
So
assume
interest payments.
Our company gives me a cut.
This is nothing compared to the interest payments, which is where
Well, interest.
the money is.
I couldn't.
Yeah,
Yeah, that bank gets a piece.
everybody.
Yep.
Yes. Yeah, for the cost of providing the service.
yeah. So the bank charges fees to the customers. This bill S-135 does not affect that part of the transaction. It's just that swipe the tab. That's the part. And again, the court, right or wrong, in this case said that they are not preempted by the National Banking Act. So those are the national charter banks. The court then looked at going over here, the applicability of, so there was in the Illinois law, there's this language about data minimization. Senator Tennant was asking about how does a payment network know what part of the transaction includes taxes and gratuity? Are they going to know everything you bought at that store. So the Illinois law includes language that is, makes it unlawful, I'm just gonna read it, makes it unlawful for an entity other than the merchant involved in a transaction to distribute, exchange, transfer, disseminate, or use the associated data, except to facilitate or process the electronic payment transaction. S 135 doesn't have that. So this is the one part where the court said this is preemptive. So the Illinois section of law that required that data be kept separate from that, that's been tossed out. That is permanent injunction. So Illinois cannot enforce that part of the law. And then that may be a problem. I don't know, like realistically how that works out. But legally, the court said that that is preempted by the National Banking Act. That this is now a little bit different. But the rest of it can stay, just the data part. Because it's not in the Vermont law, I don't think you need to talk about it. Happy to answer questions about it. The court then turned to the federal credit unions, which actually in the preliminary injunction, they were not included. And the court continued to, it ruled that way, that nationally chartered banks, federal credit unions are also, are applicable to this bill. They're not preempted. That's what they're told. They're not preempted by this National Banking Act or any other federal law. Debit cards, the court also said that they are not preempted by this law. So debit cards, nationally banks, federal credit unions, out-of-state banks also are not preempted by federal law. So out-of-state banks also are covered by the bill. Again, that's the headline. And the reasons may differ a little bit. Maybe the federal law may be different, but if the argument is preemption, they lost time and time again, except for the data minimization portion. But the court did say that there may be other ways this is unconstitutional. This might be a violation of interstate commerce. This might be a due process issue. But those points were argued. So that is my summary. Happy to go into more detail if you have specific questions about it.
Okay, so
Yes.
this is Illinois, this settles preemption issue for Illinois.
At the district court level, it's going to be
Court
appealed.
level.
Yes.
And that's okay. So
And it's
that's-
effective July 1st. So on July 1st, we will know how well it works if it's not been.
if it hasn't been appealed to. the
Right, there's not
state.
been a stay by the appeals court.
Okay.
Yeah.
All right, questions for Rick? Yes, thank you.
Yeah. Okay.
Good, Aaron. Eric, Deputy Commissioner for Banking, DFR. If you can help us understand this.
I'll do my best.
Better.
Good afternoon, Aaron Ferentz, Deputy Commissioner for Banking at DFR. I think the merits of the bill aside, my main concern with it is just the fact that if there is further court action and it does put a state chartered institution in a negative position compared to a national bank or a federal credit union, I think that's bad for the state chartered system. I would not want our institutions to suffer in that way. Otherwise, we really don't have an opinion on the bill or with the cashless business transaction goes.
There was a time we were concerned that there was a migration from state chartered to nationally chartered. And in ways that limited our power, is that still a concern? Are we still seeing that migration?
Not really. I think we're just seeing a consolidation of banks and credit unions, of all stripes, just smaller institutions are becoming part of larger institutions.
And if a state bank gets taken over by bank, this federally chartered bank, you see. That's when.
Yeah, I mean, it is a concern from the perspective of DFR no longer has authority over that activity, but there really is no
Okay,
no
so
cost for us to get involved.
that was the concern. We lose our
Correct.
control, our ability to audit.
Our ability to examine, our ability to oversee any of their activities.
Okay.
So I'm seeing like Chase Bank pop up, Chittenden County. This bill wouldn't apply to Chase Bank because it's not chartered in Vermont.
I think the bill would attempt to apply to Chase Bank and any financial institution anywhere in the country that issued a credit card that is then used in Vermont. I think theoretically it would be
Also,
subject to
being
this.
used.
Just used,
Just
Well, it talks about the issuing bank, that could, any bank in any part of the country.
regardless of whether they have a
So what
physical presence here or not.
Exactly.
What if I go online, apply for a Chase credit card, and then swipe it? Where did that card originate? Was it from my IP address, because I did it in Vermont, my mailing
Well,
address?
when they issue the credit card, they will tell you which section of Chase Bank issued the credit card. I believe
Okay.
most credit card banks are out of South Dakota, San Martin.
Yeah.
Legally.
But it's not where the credit card is, it's where the purchase is, isn't it?
Right.
Correct. This is commerce in Vermont, but it will affect any issuing bank that has issued a credit card,
And then
in my opinion.
And I think that's what I just heard Rick say, is that the Illinois court said that Illinois was not preempted from telling nationally chartered banks or banks that did not exist in Illinois or credit card companies that they had to abide by this law. Am I?
Right.
Yeah,
That's my understanding
that's the big
as well.
decision.
I guess I'm just concerned that when it is appealed, the results of those appeals could still disadvantage state chartered institutions.
And, okay.
I'm sorry I had to step out on a different bill, but, can you just, why is that? Why would why would it disadvantage? And what would you not be able to regulate anymore? I walked in the middle of that sentence.
Well, if there was another injunction as a result of an appeal that said you could not enforce this bill on a national bank, you could only enforce that on
I
state
see.
chartered
Okay.
institutions, then they would be subject to this new requirement, you know. Parts of this bill also are going to require investments in technology and manpower, like the requirements about, you know, you have to be able to, the merchant has to send in this information to that issuing bank in order to get the credit of that tax amount. That requires an investment in technology and people. It's like, it's not a free situation.
Right, but I think that is done on the point of sale, so it's the technology. Actually, but
It gives you 30 days. Not exactly sure what that's assuming you do. Is it a manual process? I don't know.
I think before we talked about the manual process where you had to put all your sales slips in an envelope.
But
and
it's also-
I don't
send
think
it.
that's true. I think it's.
That was the discussion. If you don't have the technology,
Yeah.
if the machine you have doesn't separate out those different sales, believe the bill says you submit those sales with the breakout of what you should charge the fee on.
I have a pretty sophisticated POS system. I would have no way of running a report to understand how much in taxes were charged to credit cards.
Wait, but don't you have to pay those taxes? I mean, so
I
shouldn't you
do.
know what those
I know
taxes are?
exactly to the penny what I've collected and what I have to remit, but I have no idea whether that person paid cash, check, credit card, gift certificate, gift card, whatever. No idea how they were paid for.
It'd have to be transaction. You wouldn't bundle this all at the end of the month because of returns, transactions.
I'd have to literally print a duplicate receipt for every transaction, and then it's somebody added up at the end of the month.
You can't do just like, this is how many sales on credit cards we had of books.
I can
or
see,
whatever. And
no, I cannot tie tender to item purchase. I can see how much credit card transacted, how much credit card was collected. I can see how many books were sold. I can see what the sales tax is or the meals and rooms tax, but I have no capability to say how much of my sales tax that I collected was paid by credit card. Don't have it.
That makes sense as to why businesses print fewer receipts.
Well, they can't,
Like the credit card thing, it always.
I mean, you would literally have to print a duplicate of every receipt and answer that.
When I had, yes, when I was the antique shop, I had a booth that was open.
Yeah.
They charged me for credit card sales. So I could go through every one of my slips and see which ones were paid by credit card
Mhm.
and which one I can tell you it was time consuming and I'd have to spend a lot of money on credit cards to make it work.
Because you didn't answer my second question. You just got lost in all of this conversation, which is what would you not be able to regulate? It's the out of state banks? Is that what you mean? The non,
I guess I think I was talking about how we don't have the ability to oversee a national bank or their activities in general at DFR in terms of a merger. Is that what you're?
I don't know. I walked in on you saying we refuse our ability to regulate. And my question was, would you lose your ability to regulate?
Yeah, I think it was a question when you're outside that was related to the consolidation of banks in general. And that's what I was referring to when the state charter merges into a national bank, we no longer have the ability. To
Oh, okay. So the bill wouldn't, it's just
It's not the bill.
Okay, I
It's
see.
General.
I think when a locally chartered bank comes subsumed by a larger national bank, that's when you lose your ability. Okay.
I think part of it is this is one ruling. I think you're gonna hear it's been appealed. If the next court reverses this ruling and the judge did say it was a close call.
Mhm.
Do we want to put this in action? No, we could end up like ours. Then the question is, can the credit card companies come back and say, you owe us? Or if it says that national banks, that states can't regulate national banks like this, then what do we do? Because we don't know yet. We've got one opinion by one judge who said it was a close call, so I think we're doing a cost benefit or a risk assessment as we go through this process. And see where it goes.
I think we've learned a lot over the years about being first in the nation with something. And almost invariably, we get burned.
So we will see.
One of the questions that we asked the Attorney General, how much would it cost to defend something like this?
They say nothing. We should never.
Yeah.
But we've done that. I forget what the last item was we did. Anyway, do we have any further questions?
Up to DFR, or do we have other witnesses?
We have other witnesses, yes. Okay. Thank you. Next, we have Dan Swanson. Welcome. Dan, I think you do. Is that if you introduce yourself for the record, and then the floor is yours.
Thank you, Madam Chair. Dan Swanson, I'm attorney based in DC, though I was born here. Appearing on behalf of Vermont Retail Grocers Association. You all actually invited me, and I appreciate it, last April for the hearing to appear by Zoom. So I was happy to do that. And my experience, I've worked for about 17 years for Senator Dick Durbin of Illinois, who was the author of federal debit card reform interchange fee legislation in 2010. Also worked on credit card reform. And so I was a staffer from 2006 until 2023. And just in response to some of the questions that you all were asking of the previous witnesses, it is important to focus on the specific interchange fee at issue here because it is unique amongst types of fees that banks charge. So when a transaction happens, when someone pays by card, $100 transaction at a restaurant, typically there are several fees that are deducted from the transaction amount as the money passes from the cardholder's bank to ultimately the merchant's account. Several different participants in the system, each deduct a fee. You have the merchant's bank will deduct a fee for their services. You have the payment card network, Visa or MasterCard will deduct a fee that they keep. And then the card issuing bank, so if your card has been issued by Chase with the Visa logo on it, then Chase deducts a fee. That's the interchange fee that the card issuing bank keeps. And it's the biggest fee component of all of this. It's usually 2 to 3%. But it is unique because Chase doesn't set the fee rate for the fee that Chase gets. There are fee schedules that Visa and MasterCard publish for all of the transactions for any card with a Visa or MasterCard logo. These transaction categories set the rates that the banks get and charge and deduct from the transaction amount on each transaction. So MasterCard has the same thing. Thousands of banks that issue cards and credit unions all follow these fee schedules. And that's unique. There is no other type of banking service fee that is set like that. You know, your interest rate, your annual fee for your bank, if you're a cardholder there, your late fee, each bank sets that on its own basis. And if you don't like the rate you're getting, you can go to the bank down the street and try for a different one. But all of the thousands of banks in the Visa network, all of the 1,000 banks in the MasterCard network follow these fee schedules. There's not a single one out there that deviates from them. And so that's important both operationally for these bills, but also for the legal analysis. So the judge in the Illinois bill, which S-135 is similar to, said for these interchange fees, you have to make sure that these fee, and again, these are largely set as a percentage of the transaction amount. Usually they actually do a percentage plus a flat fee. So like 2.5% plus a dime per transaction. They're saying you can't apply that percentage to the portion of the transaction amount that is tax and tip. And the Illinois law and S-135 will both say there's a couple different ways that you can convey that information. If your point of sale system allows you to do it at the time of the transaction, you let it be known then. So when they apply this rate, the 2.5%, they subtract the tax and tip amount to the amount that they're applying it to. Or the same if a merchant doesn't have that ready to go at the time of the transaction, they can send it afterwards and get a rebate for it. That's what the Illinois law would say. And so the financial industry sued immediately after that, saying this impermissibly intrudes on federally granted authority for banks to charge fees. That was the preemption argument that they made there. And after the initial analysis, once the court looked more at what these types of fees are, that's what the case really came down to. These fees are different. She said all of the different sources of federal authority for banks to charge fees and all the case law and preemption that's been built around those types of that, those are for fees that banks set for themselves on a competitive basis based on their own bank's soundness and sound banking principles. And that's not what these interchange fees are. So whereas preliminary stage of litigation, it got all confusing about banks versus credit unions versus in-state versus out-of-state. With this decision that's now been made on the merits, it's all about the fee. It's this type of fee that Visa and MasterCard set on behalf of the banks. That's what she said, the judge said states are not preempted from regulating. So that's what you're hunting on. There's a lot of other fees in the system. You know, Visa and MasterCard charge fees for themselves. That's a business charging a fee for itself. That's not an issue here. When the merchants bank charges a fee for their services, merchants can switch to a different bank. Each one charges a rate that it sets itself. That's not the problem. The problem is these fees that Visa and MasterCard set uniformly on behalf of thousands of banks. So, sorry, Matthew. With respect to S-135, I think the biggest issue, which the Deputy Director and others have highlighted, is concerns from folks about who this would be enforced against. The bill includes basically all participants in the payment system could have actions brought against them by the AG or by private right of action if the fee is charged on the tax and tip portion. So you could sue Network, Visa, MasterCard. You could sue the card issuing bank, Chase. You could sue Fiserv if that's the merchant's bank. You could sue any other participant in it. I see that Senator Perchik has introduced a new version of the bill, which narrows that to just have the enforcement targeted on the payment card network. Visa and MasterCard are the ones who set the fee rates and the rules that everyone else follows. So all you have to do is hold them accountable and say, you guys need to figure out how to make sure that these fees are not imposed on the tax and tip portion, and not have the credit unions or in-state versus out-of-state banks concerned about whether actions might be brought against them. So I think we are seeing, a shift in focus with folks, especially after this court decision, realizing, okay, the center of the action here is the payment card networks. And the judge pointed out, if there were no state authority, it basically, if you had found for preemption there, this would be a model for banks to basically get all of the fees they charge out of regulation. They would just set up a third party company like Visa or MasterCard to set fees on behalf of all of them. You know, there's no federal banking regulator for Visa and MasterCard, and if states are prevented from regulating them, they can just do this with all of their types of fees. And the judge said that can't be how the system is supposed to work. You know, Congress has made clear that we're not having blanket preemption for everything that banks do. So a approach, you know, which would be different from S-135, but is in a different bill that's been introduced, by focusing on Visa and MasterCard and saying, you guys have to ensure it doesn't happen. You can be sued if it's still happening in your systems, and they can dictate, like they do now for everybody in the system, how to make that work. So that's where I think the debate is heading here. But I'm happy to answer any questions about any piece of that. I know that it is complex.
We're trying to figure out where the other bill is.
It's an economic development.
It's in economic
We haven't touched it, but it's there.
development, because
So you got it first, sir. Yours.
no, we did not.
You got this.
I got this one last year. We haven't seen the new version. I'll need to talk to the Secretary of the Senate. Okay,
Can I ask a question?
yeah,
Okay, so thank you. That's helpful. And
Sure.
I remember this from last year now. It's coming back to me. So assuming we were to look at the new version and it's holding the Visa MasterCard accountable for making the whole thing work, how would it impact the local retailers? So what would they have to do?
Right.
Would they have to change their point of sale system? Would they have to hold all their receipts and send them in an envelope? And what would local banks that are chartered in Vermont have to do?
Sure. So under the old bill and the Illinois law and the new bill, merchants don't have to do anything. They can decide not to seek relief from interchange fees imposed on taxes and tips and just not send the information. Under S-135, that's an option. Under the Illinois law, that's an option.
Okay,
If they have the data as part of their information that they transmit at the time of sale, they can get the fee deducted then. If they have it later, they can submit it under S-135 later. All those are options. If you do a different version, like the new bill Senator Purchase introduced that just focus on Visa and MasterCard, then there are multiple options that Visa and MasterCard can do to make sure that these fees are not being charged on tax and tips. The simplest, frankly, would be they can just change these fee schedules so it's not percentage-based fees. Then you don't have to worry about it. If they were flat fees, and for years I've been saying, I don't know why these are percentage-based fees. These are inflation fuelers. When you have a percentage-based fee here, and particularly for debit, I don't know how that's justifiable to charge these fees as a percentage. It just means that as inflation goes up, they collect more and more fees, and they've admitted that it's very lucrative for them to do that. But they could change this to a flat fee, and then you never have to worry about the percentage being applied to the tax and tip portion. I'm sure they don't want to do that. There are other options that they could do. They could, change the fee rate to make clear to everyone in the payment system that they have to make sure that the tax and tip portion is excluded before the percentage rate is multiplied against the transaction amount. And it doesn't have to be done at the time of transaction with the fees pulled out. I mean, where it works right now, you pay $100 at a restaurant, they get 96 at the end of the day. You could have it where they get 100 and they get a bill at the end of the month saying, here's the interchange fees that you were owed. I'm sure banks wouldn't want to do that because they want to keep the float, but you could do that and make sure that they're complying on this. Or Visa and MasterCard could set up systems where they say, all right, we'll have it. So here's how we're going to set up the process for merchants to submit after the transaction, the information, and you can send it over their wires this way. Here's the process where we'll have level 2 data, which transmits the tax information available for all transactions. When they snap their fingers, the whole system changes. That's how it works right now.
Mm-hmm.
And they've done that. They've made disruptive changes that everyone's had to abide by before. If you remember when we switched from cards that didn't have a chip to cards that did have a chip, they just said, do it. And everyone had to do it. With respect to the banks, if Visa and MasterCard are the ones on the hook for enforcement, then banks are not going to get sued if these fees are still being charged for them. They are not going to be held liable for it. And so Visa and MasterCard are the ones on the hook to make sure that everybody makes it work. I'm sorry, Madam.
point of sale. up here, we've got a cash register. I'm pretty sure they can back things out. I go down to my local restore for Habitat for Humanity, or any, if I'm lucky, Crafts Fairs, and they've got this little box you stick. It's pretty primitive. There's so how do Visa and MasterCharge know what's tax and tip on that sale? And who, I believe I have to buy the box, or so what would that cost a merchant if all the merchants had to update to a newer, more sophisticated system?
Sure.
I don't want to see the merchants come out further behind. It would depend on their sales and how many sales. I can see a restaurant
Sure.
that
So-
has a high volume of tips.
Under the Illinois law and under S-135, a merchant has the choice. They can do nothing and the fees will still be assessed on their sales tax and tips. If they feel it's too much of a burden for them to pursue that, they don't have to. If they want to make sure their point of sale technology can transmit that information at the time of the transaction, they can do it that way. And again, there is a very competitive market for banks and processors to win merchants' payments business. Those folks would compete with each other to try and serve merchants who want to do that. So I'm pretty confident that the market would serve to make sure that that happens. And if a merchant, for whatever reason, power failure or something, I don't know, if for whatever reason they can't transmit it at the time of the transaction, wants to do it later under the Illinois law, under 135, they have, 180 days where they can, through whatever method they choose to use, whether it's double printing receipts or having a separate point of sale tracker where they keep track of credit card payments, they can provide that later and get reimbursed for that. So it's the merchant's choice. If they feel, oh, it's too burdensome, and they just don't want to do any of it, they don't have to. And then if you take the approach where the onus is put on Visa and MasterCard to say, you guys are the ones and the only ones who will get sued if these fees are still being charged, then the onus is on them. And again, the easiest way, very simple, you could do it in a minute. The whole system would adapt by it, is just stop charging percentage-based fees, make it a flat fee. And then they'd be compliant. No one else would have to look at
If
it.
if they start to lose money on this, they're going to up my interest rate.
But this is, so again, Visa and MasterCard don't keep these fees. Yes, they are fee fixing entities on behalf of all the banks.
But
So the banks,
I think we know that the merchants were getting charged in order to cover the cost for all the points back and all the promotional
Yep.
things that were going on.
so
Those were being covered in large part
that's what,
by fees.
that's what they say. So according to Consumer Financial Protection Bureau, 2024, 191 billion collected by banks in cardholder fees, interest, late fees, annual fees, 191 billion for that. 187 billion in merchant fees, interchange fees, 45 billion paid out in rewards. So they're getting almost 400 billion in revenue from fees from cardholders and merchants and paying about a tenth of that out in rewards. So they've got more money than they're
Why
paying out
don't
in
we just tell
rewards.
them they have to lower their fees?
Well, and federally on debit, there is a cap that's been put in place when Visa and MasterCard fix fees on behalf of big banks issuing debit cards. And Europe has capped fees at about a seventh of what they are here. I mean, other countries around the world have realized when you let Visa and MasterCard fix the fee rates on behalf of all the banks, there is no market competition to hold those fees in check. And banks don't really have incentive to reduce fraud or make the system as efficient as it could be because they're guaranteed the same fee as every other bank, whether they're efficient or inefficient. So it's other countries realize you got to either have market competition or regulation to keep the fees at a reasonable level and create the right incentives in the system. And we're pretty much the last country that hasn't addressed that at all on credit cards. I'm sorry, others had questions too.
Second that.
Could this kind of be a revenue generator for a merchant? Because if you don't have the system to be able to withhold that fee on the tax, and you then send it off manually to the credit card company, then get that money back, you have no way of getting it back to the consumer. So wouldn't you, in a sense, be raising that, say it's a 3% fee on 6% tax, so.
So you're saying, I mean, if the merchant has surcharged at the point of sale and then later on tries to get reimbursement for the
Right.
interchange that they justified the surcharge on, I think that's a fair point. I think right now merchants are surcharging because if, you stole $100 worth of food, you get $96 because of the transaction fees deducted. You're going to raise your prices to cover the cost of the transaction fee. So prices are going up because of these fees. And now a lot of states, including Vermont, allow surcharges specifically on the credit card payers because that's the biggest fee. That's where they're getting hit the most. I think that's a fair argument if you were going to have meaningful reform of the interchange fee. Should you limit the surcharging that right now is sort of the Band-Aid response to having this fee? This is not S-135 or these tax and tip bills are not fixing the whole problem. It fixes, 6 to 20% of the problem. The rest of the fee that's being charged is still unregulated, no competition for it. But I think it's a fair point. If merchants should not be double dipping and surcharging while they're also getting reimbursed for the interchange.
Right.
I think that would be detrimental to consumers. But when the interchange is not addressed, when that's still exorbitant because it's being centrally price fixed by Visa and MasterCard, surcharging for credit is at least sort of release valve to the merchant to go out of business. If you're single digit profit margin merchant and 4% of every transaction you're losing because most people pay by card, you're not going to stay in business if you don't have surcharge.
Okay. Any other questions?
This would be so much easier if consumers pay for the service. Because then they can choose whether it's getting the tax or the credit card, whether it's in for the credit. What do you mean? Instead of the consumer paying the fees.
So you're saying have the fees sort of a surcharge on every type of payment?
Between them and their credit card company, they buy something they pay $106, then whatever the money is, that's between the consumer and the credit card company.
But I think the point is that this fee is charged for the transaction amount. The consumer doesn't. Unlike other credit card fees where we can shop around for credit cards, this is a fee that everybody pays just for every transaction for the benefit of using the
consumer has the power to pay for, they don't want to pay the interchange fee on tax, they can pay the tax in cash. If they don't want to pay the interchange fee on the tip, they can pay the tip in cash.
Well, the consumer, so for the $100 restaurant bill, the consumer pays $100. They don't realize that the merchant only gets 96. They just don't see those fees that are withdrawn from the transaction amount as it passes from their bank to their side. So it's always been a problem of consumers not understanding their choice of payment method actually really impacts their local pizzeria.
They'd understand if they had to pay it.
Well, and that's what the surcharging is starting to do. You're starting to see consumers saying, what the heck is this 3% surcharge for credit? Why am I being assessed this? And now they're realizing there is a price, there's a cost to these
I
different
think
things.
you can assume that my local restaurant has gone up on its prices to cover the increased costs caused by tariffs, caused by fees. And I doubt that the price is going to come down if we do away with either one of them, unless they end up in a highly competitive market.
I think it would always depend on the competitiveness of the retail sector. So gas and groceries are probably the most price sensitive retail sectors. When you cut costs that go into the product, usually that does get passed on the consumer. For high-end luxury handbags, probably not.
Probably not.
To your point, Senator Beck, I mean, merchants do have that choice. My mechanic he gives me a 10% cash discount because he doesn't want to pay these fees. And then I think
That's at the gas station.
Yeah, exactly.
Or I get 10 cents a gallon off because I have a Cumberland Farms debit card and they are saving that by not.
I use my Lowe's card to get 5% off, and it's not a Visa card, it's just the Lowe's card.
But I think that like the point of a bill like this, and I mean, to your point, is we're the only country in the world that doesn't regulate this these kinds of things. And so should we say, well, this is on the consumer to take care of, this is on the individual, instead of actually going after and regulating the massively profitable Visa and MasterCard. Those are the people who are bilking consumers. And the answer isn't, oh, well, it's on the consumers to not be bilked.
So, okay, I don't know
I don't know if
that
that's
Bill,
this room.
is it a fair word to use? We
Yeah,
haven't had any
Yeah,
testimony.
the federal level.
I think we will see if we can find out what Europe does, but the operative word there is country. We may know that
Sure,
Vermont
fair
is
enough,
great,
Madam
but
Chair.
they're not a country.
When your federal government is not doing its job, then we're the next stopgap.
Right,
Oh, we have three
but
years of-
we have very limited ability, sure they.
Yeah, and that again was what the Illinois litigation was about, is it's only a federal prerogative because of preemption. And it came down to the nature of this unique fee that Visa and MasterCard set off behalf of banks. I think for other types of fees in the system, the court might have said differently, but for this fee, as long as Visa and MasterCard are charging it on behalf of banks, and they are not banks regulated by the feds, they said states can step in and act. So I think we will see a lot of different efforts by states. I mean, under this court decision, states could cap, states could do what Europe has done and impose caps on it. It's a large amount, just even on the tax and tip piece that is going out in local communities, to Visa, MasterCard, Chase, Wells, Bank of America every year. Every year that the status quo persists, it is a lot of money. So that's the tension.
So we will see if we can find out what Europe does. We will, I know when Senator Welch was here on this committee, he was very interested. We worked with him for doing some original, just limits. You can now say you have a $10 limit to use a credit card. You can't buy a pack of gum with it. The merchant chooses.
Yeah, he was the main author of the U.S. House of Representatives of the debit reform that
Yeah,
became.
so we will talk to his office and see if they can help us figure out what would be the best step forward.
and make a comment.
Yeah.
Literal office.
I got a couple more.
And so I definitely appreciate this, and I definitely agree that the country should do it. I just want to also state that cash isn't free. I mean, the handling costs of cash, by some estimates, is 4 to 15%. So these credit card companies do provide a valuable service in reducing the accounting, reconciling, bank runs, audit time, loss, slippage, theft, human error, counterfeit, lower spend. So I'm just saying that they're not all bad. These fees are in many ways cheaper than collecting cash for everything, even tax and tips. They provide a useful value to the economy.
Sure. I think the question is, are there competitive markets for all of those, for Brinks trucks and for cash registers? And really, again, 2/3 of payments now, retail payments in the country are made by card. Visa and MasterCard have 85% of the network market for cards, credit and debit. There isn't competition for these fees. That's what's unique about all this. And that's why the Illinois case came out the way it did.
And I'm all for regulation and reining it in a bit, but I just want to acknowledge that they do provide a useful value to the
Only 2/3.
Nobody forces
It's
anybody.
growing. Cash.
I was gonna say that.
Like the restaurant industry, it's 80% now. I mean, it's cash is stripping fast now.
Does Europe have the reward card?
They do. So they will say, our friends at banking industry will say, well, they have fewer banks, so it's a different dynamic. But go online and look at German rewards card for Visa and MasterCard, you'll find them. But the European Union for the entire continent, this is almost 10 years ago now, said, this is not fair the way it's structured right now. We're going to cap it at 0.3% for credit, 0.2% for debit, which is, it's 3% here for credit. So it's a lot less.
Okay,
Thank you.
but that again.
Sure.
Yeah.
Other countries, I mean, you look around the world,
Yeah.
they're doing it everywhere.
Yeah.
Thank you.
Okay. Okay, Chris Delia. Great. Okay,
It's a key for compared to conference.
Then start charging fees at the banking industry are coming to testify before us. On the credit card.
Congress in the House or Congress in the Senate?
covers the Nile. I haven't seen you guys yet. Maybe once. For the record, Chris Delia, President, Vermont Bankers Association, excuse the hoarseness. I'm not contagious, so it's okay for me to be sitting.
We have cough drops.
Oh, I believe me, I'm a walking pharmacy right now. It's all good. Very interesting comments and very interesting questions. But I want to go back to where I think we are today. Separate from countries, separate from the EU, separate from our own country. And where we are today is that you have one judge in one court in Illinois that has rendered a decision. And the Illinois case has been appealed. It was appealed, I believe, on February 13th to the Court of Appeals, 7th Circuit. And there's a sense of urgency in that appeal because, as you heard, there's the implementation date of July 1. So this, in my mind, is moving on a faster track because of that implementation date. So that's the only change. We've got a different venue and we have one rule judge. And we deal with the banks and credit unions in Illinois and the National Association of Banks and Credit Unions. So separate from the merits of do we like this, do we like that, is the landscape still very much unsettled because of that appeal. And the question for you all that you wrestled with last year was, do we wait and see until the courts resolve that issue? Or do we do something in Vermont that might open up the door for our own litigation? And I think all of you, some biting their tongues, said, sure, we'll wait. And here we are a year later. And fortunately, the court case in Illinois got delayed. I think the judge was off, was reassigned to another location for a period of time. Anyway, so at this point, we're back in court. And we would say to you today, in any discussions regarding any bill on interchange, it's that it still seems very appropriate for as much as your desire to provide some solution of relief, it seems appropriate for the Illinois case to finish out. Because we are talking about one state with an international payment system. And while it is done in other countries, one state changing the international payment system is why there's such a vigorous stuff that's going on right now. I would suggest to you that when we get past these issues of the court case, the discussion that you just had, the list that Senator Chittenden just read, is a microcosm of what you would have to consider for any bill that you would want to move forward. Because I know you guys want to do your due diligence and come up with good public policy. So this is only my list of what we would suggest you would want to look at. And that's how are transactions processed? Who are all the players in the transaction? What is the interchange? What are the fee for service structures? What's the competition in the process? Because you not only have the merchant bank, the issuing bank, but there are processors that may be in there as well. What are the real costs? I would disagree that it's 4%. Benefits of increased sales that you would want to hear about. No fraud liability to the merchants. Any fraud liability falls back on the institutions who would be issuing credit cards. What the bill does, changes in technology is a real issue because, as you heard from Senator Beck, he's got one system. Right now, the technological changes to get to a system where you're pulling elements of a transaction out certainly can be created, but they're costly. And they're gonna be costly for the merchants. The notion of a merchant doing this from a paper-based system is certainly possible. But if that's gonna require that merchant to go back to every issuing bank that's out there, that's gonna be a phenomenal challenge for them. Refunds, credit, open-ended liabilities, what's happening in other states from run surcharge, minimum purchase allowance, you just had a brief discussion about that, financial institutions decisions. I would also submit, looking at current Vermont tax policy, what do we tax, what do we not tax? How do we treat gratuities under Vermont law through the Department of Labor? Interchange is deductible as a business expense, federal and state regulations on gratuities, et cetera. So these are a lot of issues and why these discussions are so complex. And why there's been challenges to create that national movement. You're absolutely right. I was here when Senator Welch was talking about these issues, and while he is a friend, obviously we have disagreements on these, but it was a national policy on the debit card. So I appreciate the well intentions, because to Senator Hardy's point, these are our customers out there. We have seen their experiences in a current environment, whether it's tariffs, whether it's the cost of material, the cost of food, the cost of fuel, has had an impact on all of those types of customers that are bank customers. So we're not tone deaf to that, if you will. But this is a bigger complex issue that you have to look at that we would ask you to look at these issues and would want to bring information to the table to frame why positions are taken the way they are.
Thank you, Mr. Delia.
Thank you.
This reminds me, Madam Chair, and I know you're familiar with this issue, and Senator Hewlett is, who just left, but it's pharmacy benefit managers who are like the middle people in the cost of prescription drugs, that drive up the cost of prescription drugs. And every time there's a bill that tries to regulate this in some way, and I'm not suggesting that you're doing this.
I appreciate that.
But every time there's a bill that tries to regulate pharmacy benefit managers, they come in and they give you a song and a dance about why they shouldn't be regulated and how they actually, lower the cost of drugs and save the system money and blah, blah, blah. And they give us lists and lists and lists of things that we should consider. And, but the reality is, and there's a lot of evidence about this, and DFR has actually done a lot of great testimony on it about how they drive up the cost of prescription drugs and how they're not regulated. That makes it even worse. And this one feels very similar. And these are these fees that are charged for transactions only, not for, and not even transactions. They're like for the network, so it's creating this fee for something that nobody sees and nobody knows why we need it. And it is driving up the cost for consumers and driving up the cost for our businesses in Vermont. And while I appreciate that there's a lot of complicated things we need to consider, and the court case is not yet resolved, because that's how appeals go in this country. But it just seems like we shouldn't just say, there's nothing we can do, because there are things we can do. And while it'd be better if we did it on a national level, like other countries have, I still think just throwing up our hands is not the right response. And, I spent time in Europe, and the fees there are much, much, much lower. The cost of goods there right now is lower too. So it is not, we're not doing our people any favor by ignoring this issue.
If I may, spoken like a veteran in the health and welfare that sat there for many years looking at that issue.
Yeah,
We also have found a solution.
Right.
but at least we've been trying.
We have been trying.
I would suggest, Senator, that, the timing of the throwing up of hands, if you will.
What do you?
We're not sitting here saying, throw up your hands, period, in the discussion.
No, I
What
hear you.
we're saying is, it may be too early, or, well, I'll say it is too early, in my opinion, for Vermont to go down that road until there's more clarity, given the court cases. We could spend a lot of time doing something that 4 months from now, this Seventh Circuit rules, and we've just wasted 4 months because we were going down a road that they.
That's fair. I just, what we heard last year is we gotta wait for the court case. And then the court case was settled and now it's like, oh, now we have to wait for the court case again. And so I understand. I understand. I just think that, rather than throw up all these arguments about why we shouldn't do something, we should be setting the stage for when there is more clarity, we will do something, because there's.
That is a different.
That's a different discussion, and, right, but then you're getting into, you're moving away from the legal issues, which are being debated elsewhere, and now you're getting into the merits of what the public policy should look like. And again, I think it's important to understand all of the moving parts before you make those types of decisions. Because there's a cost for the system, and that's what this is. This is a payment system that merchants and customers and others rely on. And you have, not debating the amount of fees, if you will, but you have to have the fee structure to pay for that service. It's not free to run that transaction.
I know, but they make so much money.
I'm
They're
not here
running the
to,
same system in Europe and they're not.
I'm not here to debate what they're doing in Europe compared to what
Right.
you might want to do here or elsewhere.
I think the risk we're taking is, this is Illinois. We could go forward. I think it's pretty likely we'll get sued too in our district court. Having done a really good thing with data mining and PBMs, and then been taken to court and had it be a very expensive court case. This body got gun shy for a number of years. We didn't do anything controversial because we lost a lot of money for doing something that wasn't ready for prime time. And if we're going to do something, I want to make sure it's something that's going to work, that it's not just going to devolve into a court case here, which I'm sure will take equal amount of time to work through and will and in order for it to work, the merchants are, Costco and Walmart, they've all got the machines. Your mom and pops down the street don't have those machines. And I think that's, so they won't benefit. And I'm trying to figure out, I think we probably should look at the system as a whole and see if we can figure out what we can do. We did do a few things last time we looked at this with Senator Welch. And I think maybe we'll see if his office can come in and talk to us about what the thing is and what they're doing. And see if we can move forward, if not all the way this year.
We can bring them in and lobby them to do something at the federal level.
Yeah. We can.
You don't need the lobby.
Yeah.
He's already,
Trust me.
he's already vigorously done.
Yes, he was very vigorous on that.
Why, by the way, on the federal system, if this is such a great idea, why hasn't the federal system moved on it?
Wait, are you serious about that question?
Right, because I. Well, the assistant administration-
You're not getting into a lobby.
Oh, it's fire.
Well, I
Same with
would just,
pharmaceuticals.
I would just share with you, the topsy-turvy world of having Senator Sanders and the President of the United States thinking about caps, et cetera. And oh my God, who would have ever thought there would be that type of alignment? So it's a very, it's a very
Sometimes
interesting
clever.
dynamic down in D.C.
When he goes
Interesting
far
dynamic.
enough, but I've seen that happen in this building once or twice.
Right.
But the issue though is, and again, it's the concern that I expressed, when we talked about this yesterday, the day before, whatever we talked about it, is this is going to result in litigation. Just as the Illinois arrangement resulted in litigation if we move forward. And can we afford it?
I think that's the point the chair was just making, yeah.
This is going to be a ton of money. And we don't know if we're going to succeed. We don't know if we're going to get anywhere, but we do know that we're going to have some very large legal bills.
So we're gonna move on. We have one more witness.
Thank you.
you.
Appreciate it.
Keep us posted.
Of course.
And we have Steve Rauschenberger and he is on Zoom. Mr. Rauschenberger, if you're brave enough.
Can
to
you hear
say
me?
You can.
Hey, what a delightful committee hearing you're having. A couple quick things. I'm a recovering state senator from Illinois. I spent 15 years in the Illinois General Assembly, and I often tell people I got out of there without an indictment. Illinois has kind of got a reputation of sending governors to jail. I happened to serve with Barack Obama, so had kind of a colorful career there. Before I was in the legislature, I was a furniture retailer, 3 small family stores. So I go back to the days of the knuckle busters when you laid the credit card down and had to do the carbon slip on top of it. I know what it's like to do the daily mail-ins. I work today for the Electronic Payment Coalition, which represents
Mr. Rauschenberger,
issuing banks.
We just need you to say your name for the record and
Sorry.
who you present.
My
And
name
then-
is Steve. My name is Steve Rauschenberger. I live in Illinois, and I represent the Electronic Payment Coalition, which is headquartered in Washington, D.C. EPC, the Electronic Payment Coalition, includes most of the major networks, MasterCard, Visa, processors that work for the merchants, as well as issuing banks and credit unions from across the country. My job is to help legislators in various states understand the implications and the impacts of the bills they're considering. The bill before you is one I've seen many times before. It's been introduced in more than 30 states. In general, after robust public hearings, it's generally not advanced. The only state in the country that's decided to experiment with this is the state of Illinois. It passed in Illinois as part of a 3,500-page budget bill without a separate public hearing and without discussions with the financial services industry, which is one of the reasons I think that they've had some frustration with it there. I know a lot of legislators in Illinois today are a little disappointed that the federal judge didn't take them off the hook. They were kind of hoping the federal judge would decide this and they wouldn't have to kind of confront what July 1st may look like. Just a couple things I want to share with you about the system we're talking about. There's more than 12,000 banks internationally in the global payment system. So anyone from the Bank of Nova Scotia to the Bank of Montreal to the Bank of London can use their credit or debit card in the state of Vermont without a problem. Everybody understands each other. They understand how the system works. They've agreed on what the fees and costs are going to be. There's over 9 networks that carry data and participate in the system, MasterCard and Visa being largest. There's Discover, American Express, Shazam. There's a whole host of others. The Chinese actually own 2 systems that are participating. There's over 400 major processors who serve retail merchants in the United States and act as their kind of connection into the system. I would tell you it's a robustly competitive system internally as well as externally. Probably no one in this room went last month without getting a credit card solicitation. We all see how competitive the issuers are in offering changes, free, free balance transfers, points, airline miles, anything to get customers. They're very competitive. MasterCard and Visa compete fiercely with American Express and Discover. Visa just paid for some sum of money to be the prime sponsor of the Olympic Games. So only Visa cards work during the Olympic Games. The processors themselves that work for the retailers are intensely competitive. In addition, it's not just the credit and debit system that takes payments today. There's Apple Pay, there's FinTech, there's buy now, pay later, there's cash, there's checks. There are other competing and emerging payment technologies out there that are competing fiercely for the business with the merchants. So even though Dan and other people think it's not competitive, I would argue with you that it is. The percentage charged on a transaction in the United States for the last decade has either been in slight decline or flat. As a percentage of sales, interchange has not risen a bit in 10 years. So the increases that retailers are experiencing is from customer migration from cash or check or other payment forms to MasterCard or Visa or Discover or American Express, stimulated in large part by what government action was across the country during the pandemic. We've got a whole generation of young people coming up that carry their phones and want to pay on Apple Pay, which is outside of our system. So this is a trend that serves your consumers well. It's very intensely competitive. It works for merchants, except when they're told that it's too expensive and that they ought to go to their legislature for legislative relief. There are other countries that have chosen to regulate parts of the system, but there's a cost to those regulations. In the United States, access to credit is pretty widespread. About half of all retail transactions take place on a credit card, not on a debit card. In Europe, because they kept interchange at such a low rate, there's virtually no marketing of credit cards. 80% of the transactions in Europe by Europeans take place on debit. So access to credit is dramatically different. And in the American society, where we think it's important for people to be banked and to have access to credit, the credit card system itself provides more access to credit than almost any other part of our banking system. It's also important to understand our system allows any financial institution in the United States to participate. Any merchant who sells legal product in the state of Vermont can be in the electronic payment system. There's no discrimination. There's no favoritism toward big box stores. Walmart doesn't get any special advantages, neither does Costco or anybody else. So that's one of the reasons that I think big boxes have been aggressively marketing these ideas about changing the system. They'd like further advantage, the kind that they got during the pandemic when their competition, for the most part, was required to shut down. If you take a look at the externalities, you say, is this system price competitive? We all know Walmart's big enough to have their own credit card. They choose not to. They choose to use the electronic payment system because it's less expensive. Most of the airlines today choose to take just the electronic payment system because it's less expensive for them to process credit and debit transactions than it is for them to set up a cash drawer for every one of their reservationists, cash them in, cash them out, deal with change error, the threat of robbery, et cetera, et cetera. So this is a system that works for your constituents. I would argue it's price competitive when you compare it to externalities. It's less expensive than Apple Pay. It's less expensive than buy now, pay later, less expensive than the fintechs that are being developed. It's a service that works. So I just always caution legislators to be cautious about their approach. Changes to the system will cause changes to how the system works. A couple of things real quick. The interchange portion that the bill looks to regulate does not go to MasterCard or Visa. It does not go to the processor. It goes to the bank that issues the credit card, the bank that sends out that card with the chip in it, that does the monthly billing, that takes the customer's calls, the bank that extends the unsecured loan on a credit transaction. So when you swipe your card at a restaurant for $250, it's an unsecured loan to that bank. If they approve it, they're standing in your place and sending in the $250 to the system to pay for its costs. So these are fees on unsecured loans. in the United States, in the last year, the default rate on credit card balances was about 2.75% to 3%. If the interchange is 2% and the default rate on those charges exceeds that, this is not a big profit center for the banks that people want to be upset about. Particularly for your Vermont-based credit unions and your Vermont-based community banks, they don't make money in general if you ask them on credit and debit transactions or that business. They do it as a service to their customers because they want to stay competitive with other banks. That's not a problem in Europe. In Europe, the entire banking system is less than 20 banks. In the United States, we have a rich, diverse system with over 10,000 banks nationwide participating. So I would tell you it's a good system. It works pretty well. In Illinois, they're facing a lot of some real challenges with the July 1st implementation date. In Vermont, for example, it's not just sales tax that would have to be calculated and separated. Somehow the system to implement this bill would have to know the merchandise was either taxable or non-taxable, whether it was taxed at just the state rate or the state rate plus a local rate. It would have to understand what the implications of your meal and your meals and hotel tax would be on it, whether there was a local option on that. In addition, it doesn't just limit itself to sales tax and meals tax. Your bill says any state tax or any state or local tax. So there'd have to be a discussion and an understanding of how the fuel tax works, how the cigarette tax works, how your liquor tax works in relationship to this bill. So it's not like it's a plug and play where we can multiply the volume by your sales tax rate and come up with an amount to deduct. The banking industry would have to have an auditable system that their auditors and their regulators could accept to make this work. So it's much more complicated than it seems. To go simply from the stripe to the chip, where the industry was an 8-year process. First, they had to kind of come up with the chip. They had to then get the 12,000 worldwide banks to agree to migrate to the chip technology. They had to send the chip out to the people that build the terminals for the retailers and have them design new terminals so it would work. Then they had to test them. Then they had to deploy them. In the United States today, over 5% of the retailers still have not installed chip readers. So this is 15 years ago when the chip was first introduced. So the pace at which you can change the system, and if the governments tell us to change it, we will do our best to adapt. But it's not simple and it's not easy. We estimate for $1 million Vermont retailer without tips. So this would be a bookseller or a small store. Their savings from this bill might be as much as $42 to $48 a month. For that, they'd have to change their systems, change their input, and buy new software and hardware. The beneficiaries of bills like this are not Main Street retailers. The people that would make money are the ones who already have systems in place that can actually do segregation now at the data level necessary to connect into the global payment system. So respectfully, I guess I would tell you, walk slowly, make sure you understand the implications of what some of these things are. This is not a simple bill to implement. And it's basically asking your banks and your credit unions, as well as the national banks and international banks, to carry a free loan balance. In the case of a restaurant with a 20% tip and a 6% or 9% meals tax, you're saying them on a $600 transaction, you can only earn the fees that you generally earn on 400 of that transaction. You eat the tip and the tax. It's essentially what they call free carriage. So there's a risk in Illinois with the impending date that one of three things that could happen in Illinois. One, we think some international banks and some small market banks that have very little market in Illinois may simply withdraw from the market, turn off their cards in that state. We think some banks may say, we get it, we understand what you're doing, we want to comply with the law, but we're not going to carry the tax and the tip amount on the system. You can put your merchandise on your credit card or your debit card, but you need to settle other amounts in cash. The reason they do that is the $1,000 per transaction penalty is a high risk, number one. There's hundreds of thousands of transactions every single day. So $1,000 per transaction for a 25-cent error represents a risk to smaller institutions, even to larger institutions. The third thing they could do if they decided to in Illinois, and we're not sure how long this would take, is build some kind of workaround to allow multiple transactions at the point of sale. So they put the merchandise on one transaction and code it 01, figure out a coding for the sales tax portion or the tax portion, code 02, and if there was a tip amount, they would have to do a third transaction. So they could segregate those in the system with certainty, knowing that they weren't breaking the law subject to $1,000 per transaction penalty. But those are that, absent the system being modified and going through the process necessary to rewrite hardware and software, those are the three choices we think issuers are faced with. In any of those three cases in Illinois, July 1st, we think we're going to see credit card chaos. And we think, you know, the governor in Illinois would like to be a presidential contender. We're hopeful that we can kind of continue to explain to them the problems with fast tracking this kind of legislation for relatively small benefits for Main Street retailers. This emerged as a deal involving the big box retailers in Illinois losing a favorable $100 million tax situation. And the trade-off when they passed this was to give the big boxes this bill in Illinois. So I'm a former merchant. Merchants are the customers of the networks. We want them to succeed. We want you guys to be successful. We want Vermont merchants to do well. We would just caution you and say, breaking up the global payment system to kind of go after one tiny element for relatively small amounts is maybe not the best pathway for you to help retailers, and it certainly doesn't, we don't believe it helps your customers. When they regulated debit, it was back in 2010, the Federal Reserve of Virginia did a study on what happened to retail prices, because there was a lot of discussion that the regulation of debit would lower prices. They found 96% of retailers did not change their prices. It fell to their bottom line. It did change, however, the amount of debit cards issued in the United States. At the time they passed the Durbin Amendment, debit represented about 60% of all transactions, and credit was less than half of that. When debit became not profitable for institutions where they couldn't afford to do them, they didn't want to do them anymore, credit transactions rose and debit transactions got to be less. Again, you get an effect when you make a public policy choice. Last thing, and I will promise, Jeff, the idea of MasterCard and Visa setting clearance rates for transactions is not antitrust. It's not price fixing. Can you imagine an Uber where when you went to the app to get a car, they connected you to the driver and you negotiated the price each time? Or when, you know, there's lots of what they call two-sided markets where there's an intermediary who makes the transaction work by setting a price to clear the transaction. There's no requirement that any bank or any retailer in America accept the prices listed by MasterCard and Visa. They can have all of the bilateral agreements they want with each other. In fact, Costco does bilateral agreements with their cardholders. So there's other ways to do it. What those price lists do, those publicly available price lists that are voluntary and agreed to, they allow the transaction to clear with certainty quickly for everybody. So we think that's a feature, not a bug. But thank you guys for letting me tell you a little bit about my side of the bill.
Thank you. Are there any questions? I'm not seeing any. Thank you. Okay.
Thank you for letting me talk.
Thank you. I think that's it. Oh, wait. Oh, yes, no, we have an appointment to do. So Senator Matters.
Oh, yeah.
Yeah, yes, they're waiting upstairs, so we gotta run up with it.
Make motion? No, so I talked to Mike Donahue over the weekend. He's on the VEPC board and I think he was reappointed like last April or something like that. So I just checked in with him to make sure he wants to stay on the board.
Did you run into him in the grocery store?
No, just out in public. Yeah,
That's
yeah.
what you said.
It wasn't on the phone. It wasn't on the phone. It was on video. Yeah. Not that day. Yeah, so I just talked to him a little bit about it. Said, I know the meeting schedule on VEPC can be a little bit heavier than other boards and what have you. And he said he was willing to continue to serve in that role. And
Was he on something else?
he's also on the Human
Services Board, right?
Human Services.
Yeah.
Yeah.
Okay.
So he's
Busy.
got a heavy workload.
Retirement,
I don't know. Didn't ask.
okay. Is that a motion?
I would make a motion to confirm Michael Donahue as a member of VEPC.
Motion has been made. Is there any discussion? If not, all those in favor say aye.
Aye.
Opposed, say no. I'm seeing that as 7-0-0.
I love that you did that after you heard that.
I've done that and I've always known what the vote was.
Well, now I'm confused. Do I write down that I know yes?
No, you just write down 7-0. This is going on the back page of the calendar. Will get voted en masse some Friday.
Yeah, this is the all not underlined names.
Yeah.
Yeah.
Okay,
Well, excellent. Thank you.
Wow.
okay, well, you need to get the original copy from Charlotte and
Yeah,
hustle it upstairs if they
You
are
have a
all ready up down.
It's hustle.
not gonna lie, I thought I